Hello and welcome to this edition of Mic'd Up. I'm Pete Seyler, a part of the business development team here at iCM, and today I'm excited to be joined by Fran Rodilosso, head of fixed income ETF portfolio management for VanEck's Associates. Fran, thanks for joining us.
Hi, Pete. Thank you for having me on today.
Absolutely. So let's jump in and start off with just a broad look at the emerging markets debt, local currency asset class, and how it stacks up in terms of metrics such as valuations, yields, and at a high level, a place that this asset class can serve in investors' portfolios.
Okay. Yeah, great place to start. And maybe I'll go a little bit in reverse. The justification or the reasoning for placement of EM local currency debt in investor portfolios is a combination of yield and diversification. So this asset class it's pretty widely followed. The JP Morgan is sort of the dominant indexer in the local currency space, and their index, their flagship index, which our ETF tracks, has 19 countries in it. So it's less diversified than, say, the hard currency indexes, but because of the construction, it's quite liquid. In fact, you'll find bid asks and on both bonds and currencies are quite narrow in the local currency space, and the market cap sizes are quite large. So the way this index stacks up, its average rating is around a triple B. So it's a mostly investment grade asset class. Mind you, countries that issue in their own currency will typically have a higher rating on that local currency debt than they will on their hard currency debt or their dollar debt, because they have a greater ability to pay in their own currency, of course. But that's a good start. Yield, currently weighted average yield to worst in the index is around 7%, which is obviously a significant pickup over developed markets, including the US, about 250 basis points, a little more after the recent move in US rates, a pickup by going to local currency debt. Duration is lower than, say, the ag or investment grade indexes or even hard currency EM debt at around 5.1. It's a fairly diversified index as well in terms of regions, although Asia, with India entering the index over the course of the last 7 or 8 months, Asia makes up a little over 40% of the index, but Latin America about 25%, and Eastern Europe, Middle East, Africa, the remainder. So it's diversified. It is fairly attractive yield for mostly investment grade asset class, and among sort of large cap bond offerings or asset classes, one of the lower correlations with, say, the US ag. So therefore the diversification benefit, like less correlated than EM hard currency sovereigns, for instance. One other thought in terms of current valuations, I mentioned the spread or yield pickup over say the ag or treasuries. The EMFX plays a big role in this, but EMFX is in, or foreign currency levels, a little bit in oversold territory historically, not at their cheapest levels, but certainly toward the undervalued side.
Great. So let's continue down this path. And when we talk about EM debt, local currency, and obviously our use of it. So these are indeed local currency bonds, meaning our total return as U.S. investors tends to be greatly impacted by currency changes versus the dollar. Can you give us a little bit of a recap on what you saw on the currency front last year and what you'd expect going forward?
Yeah, that's very true. First of all, what you said, Pete. And interestingly, by the way, most years of positive returns for this index or asset class have been driven by 2 other factors, which is carry and local rate movements, where FX has been had a very small percentage of the explanation for positive returns or outperformance versus, say, the ag. In down years or underperformance years, it usually is that downward currency volatility among the EM currencies. So to answer your question more directly, in 2024, we saw some pretty dramatic sell-offs in EM currencies, particularly as we headed into the election, concerns about tariffs and renegotiated trade agreements. So you saw particularly some of the Latin American countries, Mexico, of course, being one of the big laggards, sort of leading the way down. So last year overall, the asset class returned a negative 2.5%, but that was about a positive 5.5% for carry and local rate movements, and minus 8% on the currency side. We started to see post-election some corrections in the currencies where some of those laggards, including Brazil, Mexico, Colombia, started being some of the better performers. And so, in other words, we think a lot of risk is priced in this area. And also rates are quite high when you're getting mid-teens interest rates in Brazil and 10% rates in Mexico. That can make up for a chunk of the FX volatility. So it's an asset class with wide return dispersion. I think last year, 8 of the 19 countries were actually positive, 8 and 19. So or at least on the local returns, we think that rate movements and carry will be the drivers in 2025. Do we expect more currency volatility? It always comes with emerging market. Do we expect the same level of dramatic underperformance versus the dollar in 2025? We don't, largely because a lot of the risks have been priced in. Uncertainty is always a negative. We have a lot of uncertainty looking forward, but that tends to hit emerging markets first, and it certainly did a lot in the second half of last year.
Right. So with the market in general kind of being keenly focused on Fed policy, with the higher for longer looking more like a reality in the U.S. So how does this compare to emerging markets, central banks, and what potential impacts does this have on the EM local bond asset class?
Yeah, I think the higher for longer posture in the U.S. certainly does put some kind of floor on policy rates in emerging markets, but it certainly doesn't impact the actual direction that EM central banks are pursuing. So about 2/3 of the countries in the JP Morgan index are in an easing mode right now, have cut, are expected to cut, for the remainder of 2025. Brazil is the only country that's outwardly pursuing an interest rate hike policy currently, to the degree where their real interest rates are super high, because inflation's actually been under control, but their policy rates getting up near the mid-teens. So it does, as I said, it puts a floor, but it also doesn't determine EM central banks. One of the great things about this index is there are many periods where you'll see very disparate. A third of the index, the banks are in maintain mode, a third might be hiking, and a third might be easing. But different things are going on in different regions. But you tend to have a common theme today, which is an important thing to note about EM. Coming out of COVID, when inflation started taking hold several years ago, the EM central banks hiked much sooner and much more aggressively than the developed market banks. Number one. Number two, they weren't coming off zero interest rate policy. They never pursued those unorthodox policies. So they all have a lot greater policy flexibility sort of built in to start this cycle. And so it's continuing. But to your point, it does probably put a floor. They might have to be a little less aggressive than they want to be.
Okay, so great information, and let's shift gears just a little bit. And with a somewhat volatile start to the year in terms of uncertainty around U.S. trade policy, can you give us a little insight around the potential impacts of tariffs on EM bonds?
Yeah, so to get into specific countries, China, Mexico, India, will be difficult because the policy is likely to change. There's posturing, there's negotiation, et cetera. There will be, change in trade policies. There already has been. There probably will be increases in tariffs. We think the impact on the bonds and the FX is already largely been felt, barring some pretty significant surprises. Even in the case of China, where we think over the course of the year you may see that additional tariff get ratcheted higher and higher. All that being said, really the driver for emerging market currencies, and of course the driver for bond yields, is growth. And the real question is more, I think, on a holistic level, what tariff policy, what U.S. trade policy, what impact will that have on global growth? And if it crushes global growth, that's generally not going to be good for emerging market currencies. That's not our house view right now. We think, we still foresee global growth being sustained. I think if you look at some of the markets prognostications, 3% or so growth for emerging markets this year might have been ratcheted down post-election, but that's ex-China. Actually, if you include China, it's closer to 4% for emerging markets, which is still a good bit higher than expected growth for developed markets this year. So a lot of uncertainty around that, but we try to boil it down to, let's focus on the growth numbers more than the policy noise and back and forth.
Great. So let's start to wind this down. And lastly, I really just want to get your view on and thinking about fixed income broadly. When you look at markets today, what do you view as the greatest risk to investors, and what makes you most optimistic about EM local bonds specifically?
Mm-hmm. I think probably the greatest near-term risk we see is, and we don't necessarily put a super high probability on it, but the greatest risk is the rate shock on U.S. rates, or developed market rates in particular. The market has been poised and conditioned to think in terms of lower rates. Obviously, we hit a floor last year, and started 2024. We saw the yield curve normalize. We saw the long end not do what people had initially expected when the Fed started cutting. So there has been an adjustment. Expectations maybe of higher long-term inflation, maybe a little bit of fiscal concerns creeping in. But any type of inflationary shock or fiscal shock that causes rates to really move, because we think we're just in a normal context now. We don't think a lot of market participants have seen a truly normalized rate environment where 6-7% 10-year yields are not that far fetched. But so that to us is just because the market is so offsides for that type of move, and we think that would also start to throw. That's the type of rate volatility that will really severely impact credit markets, which have been, the Teflon market of all markets over the last several years. So that's sort of where we see the greatest risks. I think there was a second part to your question. Oh, what makes me optimistic about EM? Sort of
absolutely
in that context. This is really about what I said earlier. Sort of emerging markets were not zero interest rate policy. They weren't QE. They couldn't, in most cases, couldn't even afford the sort of fiscal excesses that developed markets had positioned them for over several years, or in some cases over the last couple of decades. So the fundamental point is better. Lower debt to GDP by almost half. Below 60% for EMs on average versus about 110% for developed markets on average. Better fiscal balances, better current account balances, and more orthodox central bank policy, which gives them more policy flexibility. They get punished when still as a risk-off trade, because so much of the money flows from developed markets to emerging markets. There's still volatility. They get punished when bad things happen. But I like the starting point from a fundamental point of view, and then the question is, what about the valuations? And we think, on the currency side, certainly EM currencies really beyond just last year, but the last 5 years or so, for the most part, have stayed in undervalued territory versus the U.S. dollar on sort of a real effective exchange rate basis. We are not looking for a catalyst for them to rally strongly. would anticipate there will be situations though where they're, over the long run, exhibit greater stability versus the dollar. And then in that environment, we think all those other fundamentals lead to outperformance for EM local currency debt.
Fran, I can't thank you enough for joining us today. It's been a pleasure having you.
Thanks again, Pete. I really, really enjoyed our conversation.
Great. And for our viewers, if you have questions about our topic today or a suggestion for a future episode of Mic'd Up, please do reach out to us at 888-426-4689 or via email at info@icm-invest.com. Thanks for watching.